Good morning, everyone. This is Curtis Hawks over here with Insurance Agency Marketing Services, and I appreciate everybody taking some time to join us this morning. I have a really good topic talking about wealth transfer and asset transfer. When I look out at the marketplace, we are facing one of the largest generational transfers of wealth over the next couple of decades that we've ever seen. And so the need to transfer assets in a tax-efficient manner, I think we're going to continue to see increases in interest from the consumer marketplace. And so we've got some good ideas that we'll talk to you about today. Before getting into the main presentation, I did want to talk about some of the additional ways that IAMS is here to support your business. So first off, we've got our new producer builders. And this is a great way if you're new to IAMS to whether it's generate more prospects or get marketing dollars. You can see that we've got a variety of point totals up there. And so you can cash in on that at any time in your first 6 months with us. And as I mentioned, whether it's marketing programs, marketing dollars, we've got cash, trips as well. Those are all available. And if you've got questions on that, reach out, talk to one of the sales directors over here. That number is 800-255-5055. In addition to that, we've got our referred producer program. If you have an agent that you know of that you think might be a good fit for us, or maybe isn't quite happy with the current IMO relationship, send them our way. Not only will you get a $50 bonus when they get contracted, but then on an ongoing basis, you can receive money on their business. You don't have to do anything. We'll take care of all the service, and it's a great way to generate additional revenue back into your practice. We also have our marketing reimbursement program. You can see up there for qualifying indexed annuity premium, you can accrue $100 for every $100,000 of premium. And then on the life insurance side, $200 for every $100,000 of single premium life, and $200 for every $10,000 of life target. And if you've got questions on that, just reach out, talk to a sales director over here. Again, that number is 800-255-5055. In addition to that, I'll touch on our back office support. It's been a cornerstone of IAMS for 38 years, and whether it's pre-sale in the case design and illustration phase or the submission to commission process, the team does an amazing job over here. And so if you haven't tested that out, I would strongly encourage you to do so. In addition to that, we've got the IAMS portal, which can be an amazing resource for you. Not only do we have quoting software on there for annuities and life insurance, we have current rates, we've got marketing programs, marketing ideas, we've got our sales resource library, which literally has hundreds of point of sale pieces that you can instantly download right off of the website, as well as the ability to do e-applications. You do need to be contracted, though, to access it. So if you're not currently contracted with IAMS, just reach out, talk to a sales director over here. That number is 800-255-5055, and they can help you with that. I mentioned that we do have e-app platforms on the IAMS portal, so you can see that we integrate with all of the most common e-app platforms for annuity life as well as Medicare. And if you've got questions on that or want to see a breakdown of the carriers, here's an example of one of the cheat sheets that we have where it will tell you what e-apps to use for what carrier and product. We also have an in-house creative team. They do an amazing job. I think one of the key benefits with them is they just specifically focus on the financial services space. And so I think that makes doing business or working with them easier. You don't have to explain to them what retirement planning is or how an annuity works or life insurance. They already know that because that's what they work on all day and every day. And so the other piece of this too is they will work with you as long as they need to get the piece put together exactly how you want, which is, I think, a big difference from traditional third-party ad agencies, which typically give you a couple of rounds of edits, and then after that, you've got to spend more money with them. And so if you've got questions on that, just reach out, talk to a sales director over here. That number is 800-255-5055. In addition to that, we've got IAMS Wealth Management. So this is a platform that we built out several years ago, and I'll go ahead and I'll launch our first poll of the day. But we've seen significant growth in the IAR space with more and more agents looking at adding AUM as a piece of their business. I think it's a great opportunity, and IAMS Wealth really has a focus on a high degree of service and helping agents to make that transition. So if you've got questions on what that looks like and the scope of the services that IAMS Wealth provides, just check yes on the poll, and I'll have somebody reach out to you and follow up with you. So I'll go ahead and get that closed down, move on to our next slide, which is our Life and Annuity Academies. We just actually wrapped up Life and Annuity Academy last week, had an amazing event, had a really good group of agents in-house, but it really is a great opportunity to spend some time working on your business, to really look at what is the landscape in the annuity space, what's the landscape on the life insurance space, what are current trends when it comes to marketing, and be able to walk out of there with items that you can not only implement right now, but items that you can incorporate into your business from a more long-term standpoint. So I'll go ahead and launch our second poll. We typically recruit to these and sign people up for about 30 to 40 days, and then get everything booked out about a month before the next event. So our next event is going to be the latter part of September, so we've got a little bit of time here over the next few weeks if you're interested to get registered for it. I would tell everybody that these events do fill up relatively quickly. That's part of the reason why we do several of them over the course of the year. So if you've got interest, just check yes on the poll, and then I'll have a sales director reach out to you. I'll go ahead and get this closed down here. So lastly, make sure to follow and like us on Facebook and LinkedIn. We syndicate a lot of content on social media as well as our email marketing, and so it's one of the quickest ways to see rate changes, new marketing ideas, new product rollouts, etc. So go ahead and pause there, and I'm going to get this switched over to my co-presenter today. So I've got Doug Murphy with Baltimore Life on the call with us today. And as I mentioned, wealth transfer, asset transfer is a huge topic, and it's going to continue to be a huge topic. And there's a lot of different reasons for that, whether it's ambiguity about tax rates and what that holds, or longer life expectancies, but single premium life insurance can be a very effective asset transfer tool. And so I've asked Doug, he's the VP of Sales and National Accounts with Baltimore Life, to hop on a call with us today and kind of give us an overview of what that landscape looks like, as well as the product solutions that they have. So Doug, appreciate you taking some time with us this morning.
You can see my screen. I hope you can. So thank you for having me. I really appreciate it. Thanks everybody for attending, taking time out of your day to be a part of this. But I always like to start by thinking IAMS. I mean, I can't tell you what a great organization. I've been with Baltimore Life now since 2008, so a little over 16 years, and it's the finest organization that I deal with. I mean, from a professional standpoint. I mean, Curtis just went through a bunch of things there, from the support they give you to some of the technology and things like that. Those are things you don't find, or I don't see, with the other organizations that I do business with. So Curtis, I compliment you guys on that, and it's a fantastic program, fantastic organization. And I say that because at Baltimore Life, I'm the VP of National Accounts, head of all sales nationwide for IMO distribution, and I don't have any regionals underneath me at the time. So I keep all my relationships at a minimum that I can, and it's just dealing with top line organizations that do a lot of good business with us, and IAMS is at the top of that list. So I do appreciate it. I appreciate you guys having me on. So with that, I always start with this slide here. Two things I like to point out. One is this is asset transfer for the middle market. It's not designed for clients wanting to move millions and millions of dollars to the next generation, or to their heirs, to churches, charities, that kind of thing. It's really for the middle market, and it's simplified issue products. Both of these products we're going to talk about today are simplified issue, minimal underwriting. And the last thing there, that bottom line, I want to help you grow your business. I'm not trying to take money from something you're doing. I mean, you guys work a lot with annuities, I assume, and you're working with clients that may have money out there, the asset funds they're going to need to live off of whenever they retire, or sometime during their retirement program. If that's the case, those funds probably aren't best designed to be going into one of our products. Our products are designed to use money that's not going to be needed or necessarily needed for to live off of in retirement. So I want to help you grow your business. I look at it as a kind of a companion product to annuity products that's out there. You guys sell annuities, you know where the people who have the money, you know what the purpose of the funds are and that kind of thing. And if the purpose of the funds is not to live off of, they just kind of got it out there, I think you're going to find these two products to be fantastic for that. So let's get started. You know, I always like to start, and I don't know the level of expertise within the agent population that I'm talking to, so I always like to just kind of point out who our typical client is. You know, as I mentioned on the first slide, this is middle market clients. They're looking to live comfortably in retirement. They're looking to maintain a good health. They're interested in the happiness and welfare of their children and grandchildren, and they want to leave some assets to their heirs if at all possible. And they need guidance from an agent. They need an agent that helps them understand what their needs are. The client knows what their needs are sometimes internally. A lot of times they've not been able to articulate that and see that on paper, but they need an agent that can help them do that and then help them arrive at those solutions. And the last kind of bullet point I've got there is a client should understand these solutions in 5 minutes. And there's no magic bullet around 5 minutes. I just like to point out that these are fairly simple concepts that we're going to talk about with these two products and how they fit these needs. And it shouldn't be something, we're not going to be talking about index products or the Hang Seng index or any other type of index that you may have. Both products are based off of whole life chassis products. So they're fairly easy concepts for those clients that says, hey, I've got money set aside. I'm just not planning to live off of it. I've just got it out there for other purposes in case I have to have it. You know, these senior clients, and I'm part of that group, a lot of times break their retirement planning process down into three kind of what I would call three buckets, or in this case, I've got illustrated here as like mason jars. And whether they've done this on paper, or they've done this with an advisor, or they've just got this in their head, typically they're thinking about their retirement years in retirement funds, money set aside to use to live off of, contingency funds, that money I call what if money. What if I need money for this? What if I need money for that? And then a legacy fund, money that's left over that they've got set aside that they can leave behind to their heirs for that purpose. And I realize this can be done through trust, but most middle income market clients don't want to undergo that effort or give up any control of those assets. And Curtis, I'll tell you here too, if you see any questions out there, I'm not looking at the side of it. I'm going to show my whole screen, so I'm not looking at the questions. If something comes up, be sure to stop me and ask those questions as we go.
Will do. Yep.
Let's talk about retirement funds first. And when I talk about retirement funds, I'm including any expected Social Security benefit, pension plans, in this case specifically defined benefit pension plans, and the distributions from 401ks, IRAs, 403bs, et cetera, and that kind of thing. Now, according to a 2017 American College study, and this is American College that you would get your CLU, your CHFC, or your CFP through, they do studies for the insurance industry all the time. And according to a study from them, people between the ages of 65 and 70, 75% of those people had a defined benefit pension plan. Now, some of you out there may be too young to really realize what a defined benefit pension plan was. Back prior to 401ks, or just as in that transition, most employers, or a lot of employers, had defined benefit pensions where it was their responsibility to put money into funds and into asset that would build for the employees to build for a retirement program. It was their sole responsibility to make sure that they said, okay, an employee who lives age or retires at 65 or 70, and they're going to retire for a certain period of time, then we're going to guarantee them a certain pension plan. And it was a defined benefit. It was a defined amount of money, and they had to fund for that kind of distribution. It was a very expensive program. Most companies nowadays don't have it. Very few still have a defined benefit pension plan. But a lot of these senior clients, myself included, have a portion of your retirement funds set up in defined benefit pension plans. Mine ended in 1995. At that time, my company started a 401k plan, and I've been under a 401k plan since that time. But the defined benefit pension plan didn't go away. It was frozen at that time. So be sure to understand that about your clients that you're talking to them. Now, baby boomers entering retirement. These are retiring baby boomers, have a median savings of $147,000 in all of their household retirement accounts. Now, that doesn't sound like a lot, but that's actually up from $99,000 in 2012. 22% of baby boom workers, these are people that are still working but of that baby boom age, have less than $55,000 saved. However, just over half of that group, that group of 22%, only half of that are very concerned about outliving their savings in retirement. Now you ask, how is that possible? I mean, what are we talking about asset transfer? If these are the retirement savings programs that baby boomers have, you know, they're not concerned about outliving their income when they've got less than $55,000 saved. Well, I go back to that defined benefit pension that I put so much emphasis on, and that a lot of these senior clients, because they do segregate things out, they're living off of their Social Security benefits and their defined benefit pension plans. Anything they had saved and had ability to set aside, like in a 401k or something else, that's kind of falls into that second bucket, that what if fund that they've got set out there. If they need it, they're gonna use it, but if they don't need it, it's money that they're going to pass on probably to their heirs or their church or the charity or something else. So keep that in mind. My parents fall into that bucket. My dad, his defined benefit pension went away in the mid 90s as well too. They went under a 401k. Him and my mom live off of their Social Security and their defined benefit pension plans, and they've got 401k money set aside that they set aside for what you would call that what if. So keep that in mind when you're talking to these seniors, even though they look like they may not have a lot in these 401ks and IRAs and that kind of thing. Contingency funds, that's that second bucket. These are assets your client don't expect to use to live off of. That's important when you're looking at these clients for these particular products I'm going to talk to you about. Funds set aside for unexpected financial crisis or a medical need or a long-term care need, let's say. Underperforming retirement funds or outliving their retirement funds. Now, I realize that life insurance can be used to help do that, but in this case, we're going to talk about that as just as a what if, money that they're going to have set aside that they need just in case they have some type of emergency. And then the last bucket there, I don't have a slide to illustrate it, but it's really that leave behind or that legacy fund, the life insurance, and that's where we're going to get into the presentation today. Money that they don't need to live off of, they've got set aside, and what can they do with it to make sure that if they've got some money set aside, that if they need it in an emergency, they can access it, and if they don't need it in their lifetime, that they can pass on more than maybe that they had expected to, and do it tax-free through life insurance by utilizing one of these two products. Two products we're going to talk about is our single premium whole life product. Again, it's on a whole life chassis product. The second product is going to be it's a unique product. I don't think there's any other company out there on the market that's got a product like it. It's called Generation Legacy, and I'll get into that. We're going to spend a majority of time today on the Generation Legacy, but this is kind of a slide. And Curtis, if you all don't have this, it's available out on the Secure Agent website or out on the website. You can go out and actually download this comparison sheet. It just gives you a good comparison of the two products, and where you might one product might fit better for a client than the other. And just start off by, a lot of times an agent will ask me, which one is a better product for a client that has $75,000 that they're not planning on living, they got it set aside. And the most obvious answer is that first green arrow up there. What's the source of the premium? Where's the money coming from? If the money's coming from an after-tax cash vehicle, a CD, a money market, 1035 exchanges, any other type of cash, that money's probably best utilized going into the single premium whole life. However, if the money is qualified or non-qualified annuities, or it's got money in it that's never been taxed, and you're trying to minimize the tax that client pays and pass on as much of the legacy as you possibly can, that money's probably best suited going into our Generation Legacy. So that's the biggest distinguishing feature between which of the two products that you would position and present to a client here. All of these other areas down through here I'm going to go through briefly, but they've all got a little bit of differences, and all of them are surrounded by mortality issues or underwriting issues or things of that nature. How the product's structured, and if I can, I'm going to spend a little bit of time on it. If for some reason that I got some time left over at the end of the presentation, I'll be glad to come back and elaborate on those. But the issue ages for the single premium whole life go down to from age 50 all the way up to age 85. And the Generation Legacy starts at age 60 and goes to age 80. So the big point there is that the Generation Legacy, we're going to have to ask that client, what's the purpose of the funds? We don't feel like a client in their 50s, if they've got money set aside in qualified funds, if they understand that whether or not they're going to need those in retirement or not typically. So we start the Generation Legacy at age 60. We feel like somebody by the age of 60 is going to know that. It only goes up to age 80 on the generation legacy because of mortality and the way the product is structured, and you'll see that a little bit later in the presentation. Underwriting classes, there's 2 underwriting classes for the single premium whole life. Level 1 is a standard underwriting tables all the way up through table 4. And then for those clients that have maybe comorbidities or a couple of more impairments, that we have a level 2, which is basically the same premium. It is the same premium, but it's the same premium buys a little bit less insurance. So let's say that a client is level 1 and they've got $50,000 of premiums that we're going to put into it. It might buy $78,000 or $80,000 of insurance based off that client's age. If they've got more health impairments, they fall to level 2. That same $50,000 of premium may only buy $74,000, $75,000 of death benefit. With the generation legacies, are the only one table, the standard table 4. Both of these products offer point of sale underwriting, and right now this slide shows over a 90% point of sale decision. I would tell you that we're very close to 100% point of sale underwriting before you leave the client's house. You're either going to know electronically or over the phone whether or not that client qualifies medically. Both products have a minimum of $5,000 to the premium. And the next 3 arrows, I'm not going to spend that much time on. Again, I can come back to it if you want me to later, but they're what I call that contingency fund. What if I need money to take money out? What if I need money access for a car repair, home repair, a major medical issue or medical issue of some sort, or a long-term care issue that we may have? That's partial withdrawal options, the loan availabilities, and the accelerated death benefit. Both of the products have partial withdrawal options from the cash values of life insurance policies. Both of them offer loans. It says here a maximum loan rate of 8%. Right now it's at 6%. And they both offer accelerated death benefit features. Now, if you look at this just real quickly, you're going to think, well, man, the single premium whole life looks like has a much more lucrative accelerated death benefit features than the generation legacy. You can see there for terminal illness, it's 95% of the single premium whole life. For the generation legacy, it's only 75%. And you can see the corresponding decreases down there. I would tell you that the way you see the product structured on the generation legacy, you'll find that those are probably pretty equal. And according to how soon after the policy is issued that the client would qualify for one of those due to and the way they qualify for either one of these products and qualify for that, they have to have a doctor tell them that they're terminally ill, or they have a long-term care need, and they can't do 2 of 6 ADLs, the activities of daily living that are normal qualifications for qualifying for long-term care. Now, keep in mind, this is not long-term care insurance. It is the acceleration of the death benefit. But if somebody came to you and said, hey, Curtis, I need money out of my insurance program to help cover some nursing home costs or extended home health care costs or adult daycare costs, that kind of thing, they could access that. But they've got to have a doctor say you're going to need that type of care, and you can't do a 2 of 6 ADLs. And if they can't do that, then they can qualify for that. They can accelerate these death benefits and use that money to help offset some of those costs to do that. And again, this money's paid directly to the client. It's not paid on a monthly basis. It's a lump sum payment. It's not long-term care insurance, but it is an acceleration of the death benefit. The maximum face amounts here for both products, I will point out here is that we have recently increased this dramatically, but I have to illustrate here on the slide. These are the amounts that you can go out and illustrate. If you went out to iPipeline or went out to our illustration software, you could go out and illustrate anything that falls within these 2 buckets yourself. Anything above this table, and I'll give you the maximums in a second, you need to call into our agent services line, and they can run those illustrations for you. Since these products are reinsured, we have a reinsurance treaty on these 2 products. We can't violate that. Anything above these net amount at risk, we're accepting that risk ourselves, but we can't publish anything above that because it would violate the reinsurance treaty. So you can look at these things here. If you get a client that's level 1, 50 to 80, you can illustrate up to $250,000 net amount at risk. If it's level 2 for 50 to 80, you can go up to $200,000 net amount at risk. And what a net amount at risk is, it's the difference between the premium you pay and the death benefit. If you've got somebody that's 50 and wants to put in $500,000 of premium, you probably couldn't do that because it would exceed $750,000 of death benefit. But if you got somebody that's 80 and they want to put in $500,000, you could probably do that because it's not going to be above that $750,000 total death benefit. So hope that makes that fairly clear in how we would maximize the death benefit there. we would go up on a single premium whole life. We're going to go up to $1 million or up to $500,000 of basically double those net amount of risk there. So you can look at that. But if you want anything above this here, you want to illustrate it, you're going to have to call into our agent services line, and I'll give you that number in a few minutes to get those illustrations. For the generation legacy, you're going to find when we do the next slide how we created the generation legacy. And this product was really designed to move money tax efficiently out of qualified funds, non-qualified annuities, and move it into life insurance in a tax efficient manner. That's the best way to describe this to a client. How can we do that? Minimize the tax to the client, maximize the death benefit that the client's going to leave behind to their heirs, and do it in a tax efficient manner. So when you're taking a generation legacy app, you're going to take two applications. Really, one application is just two sections. You're going to have an annuity, a single premium immediate annuity application. Part of it there is going to be part of a page, and then the second part of that application is going to be the life insurance application part of that. In a few cases, that might be a separate person, and we'll get into that a little bit later. But in most cases, it's going to be the same person, so you're only going to need to fill out really one section of that and let it apply to both sections. But you're going to deliver two policies. You're going to deliver a single premium immediate annuity policy to the client, and you're also going to deliver a whole life policy, either a 10-pay policy. If that client is between the ages of 60 and 74, you're going to deliver a 10-pay policy. So maybe a 10-pay policy. If the client's between the ages of 75 and 80, it would be a 7-pay life policy. And again, that's because of mortality issues that we run into in the way the product is structured. The death benefit for the single premium whole life is basically that. You put in $50,000, it buys $78,000 or $80,000 of death benefit based off the client's age, tax-free. They never make another premium payment. The cash value starts to go up from its starting point to that, continues to go up every year. They make no more premium payments after the first premium. The generation legacy, again, it's a one-time premium payment, but you're going to fund, what you're going to do is fund that single premium immediate annuity. And then every year for a 10-year or 7-year period, that single premium immediate annuity is then going to make an annual contribution. Basically, the annual payment out of that SPIA is going to fund the premium on the life insurance policy. So let's get into that. And again, Curtis, this form is available. Anybody, the form's available to you out there. If you go out and download it off our Secure Agent website, or if not, I can provide it to you and Curtis can get it out to you. I'm going to show you two different illustrations. This here's a female age 70. She's non-tobacco, typical client for us. She's got a $50,000 annuity out there, non-qualified annuity with a cost basis of $40,000. So you can see our software right there below the 40,000 calculates the exclusion ratio for you. 76.2% of any payment that would be excluded from estimated income tax. So let's take that. And this client says, hey, I don't need this money to live off of. I've kind of got it out there for a what if money. What if I need it? I want to have it. I don't want my heirs being responsible for any type of long-term care or significant health issue that I have, those kind of things. I just need some money that I can access to get to in the event that I need it. But I want to pass on as much money as I can to my heirs, to my grandkids or my kids. So we're looking at here at taking this $50,000 annuity. We're going to 1035 exchange that from her annuity into our single premium immediate annuity, our SPIA. So you can see there in year one, that single premium, we've now moved a 1035 exchange. We've 1035 exchange that. If you're in the annuity world, you understand you can 1035 exchange from annuity to annuity or life insurance to annuity, but you can't 1035 exchange annuity to life. So that's the reason we set up the annuity here to be that holding bucket, and that bucket that distributes the funds over the next 10-year period. So now we have that money into our SPIA. It's in there tax-free so far. The client's not paid any income tax on that transfer. So because the client is age 70, it's a 10-year life policy. So we're gonna take that SPIA payout of $5,250, which is really 10% of the fund, 10% of the SPIA, plus the interest that we're crediting to it. So we're going to have an annual payment every year come out of that SPIA, $5,250. It's going to fund a life insurance policy tax-free of $83,347. You see over there to the very far right-hand side of this slide. So that's the whole life death benefit. This client dies in the future, That's how much tax-free she's now going to be able to pass on to her heirs. So how does this benefit the client? It benefits the client, and it benefits you and the client both in a number of ways. The client is going to benefit by saying, okay, what if that client is trying to minimize the tax? In this example, we were able to take the full $50,000 of premium. Instead of paying tax on that $10,000 of gain they had up there above, if she said, hey, I don't need this $50,000, you took it, cashed in that non-qualified annuity, you put it into life insurance, you're going to have less than $50,000 single premium there, which is going to buy less than the $83,000 of death benefit. So we've maximized the death benefit for the client. Now we're going to try to minimize the amount of taxable income that she's got. So out of that $5,250, based on that 76.2% exclusion ratio, we're going to exclude just over $4,000 in this example, right at $4,000.50 every year from her tax, and we're going to send her a 1099 every year for 10 years of right at $1,250. You can see it's a little less than that in the first 9, a little more than that in year 10. So right at $1,250, she's going to get a 1099 on to have to include in her tax amount. Now, typically, that's not going to throw her into a higher tax bracket. In some cases, based on her other income, she may not have any tax to pay on this at all. But in any event, what we've done is minimize the amount of tax she's going to have to pay and by spreading it out over a 10-year period. This also benefits the client by having the ability out there to pay. What happens if that client dies in that SPIA payout period? We're going to pay the whole life death benefit tax-free, but then we're also going to pay what's remaining in that SPIA according to how many years we've paid out. So that we feel like, you know, there's one company out there, National Western is the only company that's got a product like this that I'm aware of, that says, hey, we're going to do this. But they take the funds, they took the $50,000. They wouldn't have provided any more than $83,000 death benefit, but they would have considered the money in the annuity as a temporary annuity. If that client died anywhere in that 10-year period, they would have kept what's left in the annuity and only paid what's in the whole life death benefit. We felt like it's the moral thing to do. We also think it's the legal thing to do in separating these policies and paying out both the whole life death benefit and what's left in the SPIA at the client's death. And you know, that's, if you think about that, you know, when we created this product, I realized you could take this same $50,000 annuity this client's got, you could put it into a company that's got a SPIA. You could find a life insurance policy that you could create on a 10-year payout perhaps, and then you could match those together. It would be hard to do because when you got to find a life insurance policy, simplified issue, you got to match the company that's willing to issue the annuity on the exact date that the funds need to go into the life insurance policy with a different company. And it's hard to do. We've just taken that concept and done it for you. So why create a problem for the client by keeping their annuity funds and not paying those out? So we've created 2 different products, 2 different policies that you're going to have here, the SPIA and the life insurance benefit. So let's say this client died in year 3. The death benefit to her heirs tax-free is $83,347. We're going to pay out either $30,200 as a commuted lump sum, or we're going to continue to pay that beneficiary the $5,250 for the remaining 7 whatever years are left in that payout there. So that the beneficiary at that time can choose to do that. They are going to, obviously that money would be taxable to them, but the $83,347 covered under the whole life death benefit would be received tax-free. Now, for those of you that, let's say, what about a higher face amount? Okay, this is a same type of client. She's 73. She's just now qualifying for her RMDs or having to take RMDs. So you're saying, okay, because that's usually the type of client I say is a typical great client for that. A client that's now having to take RMDs. She says, hey, I've lived age 73, probably retired somewhere around age 65. I've demonstrated that I don't need this money to live off of. I lived in the last 7 or 8 years without it, but I've got $200,000 sitting out there in a non-qualified annuity. And what can I do with that? I got a cost basis of $125,000. What can I do with this? These kind of funds. So you take that $200,000, same concept. You're taking that $200,000, 1035 exchange it into our SPIA. It's going to have a SPIA payout every year of $21,000. A little over $12,000 that's excluded every year from the payment from any tax. They're going to get a 1099 every year for $8,505. So that whole life benefit now, instead of being $200,000 that they're passing on to their heirs, is $305,321 tax-free for the rest of their lives. This is not, even though it shows paid up in 10 years, this is a policy that's a 10 pay policy. It's not, it doesn't go away in 10 years. It's a policy that's only paid on for 10 years. And if they died in that annuity payout period there, you can see at any point in time, whatever's left in that annuity payout, we're going to either commute the lump sum or continue to pay that SPIA payout to them for however many years is left in that payout. So I think these are good illustrations. They're taken right off of our illustration software on what a client, how a client would qualify for this. So you can look at that and see how this would benefit a client. Would they rather pay tax on $75,000 up front and use what's left to buy life insurance? One is probably going to put them into a higher tax bracket. They're going to add their tax to whatever other income that they've got. They're going to have a lot less funds used to be able to buy life insurance on. So this is benefiting the client dramatically, we think. I mentioned to you earlier that typically on the application, the client for the annuitant and the life insurance client are the exact same person. However, sometimes you're going to run across a situation where that 73-year-old female that we just talked about, that's got those money, that $200,000 set aside, she's uninsurable. She can't qualify for life insurance based off of her health. But her husband, in this example, her spouse, does qualify medically. So we know that they're probably, if they're married, we don't know it for sure, but we're going to assume that they file taxes together jointly. So with that said, we know that they're probably both have the same needs and outlooks and wants for what the funds would be used for, what they want to pass on as a couple to their heirs. So we enable what we call the spouse option on the generation legacy. You can say, okay, well, the lady, the 73-year-old we just talked about is uninsurable. She would still be the annuitant. The annuity is still in her name. So the SPIA would be issued in the annuitant's name, but then the life insurance policy in the application would be taken on the insurable spouse. And so that what we're doing there would be using the annuity in one spouse's name to fund the life insurance policy and attach it to the 10-pay policy on the insurable spouse. So we call that the spouse option. You can't do it for business owners right now. We're working on that concept, but you can do it in a spouse. It can't be done for siblings or children or anything along those lines. It has to be, in this case, has to be a spouse. The healthy spouse becomes the life insured. The SPIA payouts continue to fund the life insurance policy. If the annuitant dies, so if the annuitant dies, those annuity payments continue to pay that during that SPIA payout period. The annuitant waives a right for the beneficiary to commute future SPIA payouts in the event of a lump sum upon the annuitant's death. And there's no maximum age limit for the annuitant. So you could have a spouse that's 87 and a life insurance client, the life insurance applicant that's 83 or 84, and make this happen. So there's no maximum limit for the annuitant when the annuitant is different from the insurer. One of the things I think is going to benefit you and the client both is if you're at a client's house and they go there and talk to them about their annuity, which you're familiar with, and you get into the concept of talking about the generation legacy or maybe even a sales situation with a single premium whole life, you're going to have, what we want to do is make sure you don't leave that client's house without knowing whether or not they qualify medically. It's important to us that you don't, if for some reason we don't want them because they don't qualify medically for us, for our product, we don't want to end up costing you a sale, and that you know that before you leave that client's house. So once you've completed the entire application and pre-qualified the client, you're going to contact the call center. You can contact them either by telephone or you can do it electronically. It says here the call typically generally lasts 12 minutes or less. The more proficient you come at this, and the more the client has access to any medicine they may be taking, any prescriptions and that kind of thing, you can do that in typically about 8 or 9 minutes, and you're going to know within that time frame whether or not the client qualifies or not. That call center rep will ask you to verify the contract state, the client's name, address, date, the state of birth, height and weight, and only the last 4 digits of their social security number at that point in time, and then their gender. During that call or that EAP process or that electronic DocuSign process. An MIB search will be done, and a prescription drug database will also be run in the background. So it's important that that client be on the call with you when you call in, or be able to DocuSign on your device that they're agreeing to have these two vendors, MIB and the RX database, tapped to be able to get this information. Without their signature, without their authorization, we can't do that. So that's going to run in the background. Once we've gotten that information back, we're going to be able to give you an underwriting decision right there on the phone. And again, a client signature is required and can be taken via voice or DocuSign to generate those two vendor MIB and RX check kits. Once you've done that, the call center rep will provide you with one of the following responses. Your client's conditionally approved based on final review for Tier 1, that's both for the Generation Legacy and the SPWL, or they're conditionally approved based on final review for Tier 2, and that would be for single premium whole life only. Or the third option there would be the client is declined at this point in time. If they're declined, you can hopefully get off the phone, talk to them about a carrier that may take those impairments, or if not, pivot into an annuity presentation that might also be satisfactory to that client. Again, we don't want you getting off the phone without, if there's a sales situation available, we don't want to cost you money by declining the client later in the process, or even later after you may have sent the application into it. We want to do it while you're there with the client. Since there are fewer than 10% of the cases will be referred to home office for additional underwriting. Right now, that's negligible. I would say close to 100% goes straight through, and that's our objective. The call center, and again, this is going to be in the agent guide. I always like to point out here that if you haven't contracted with Baltimore Life, be sure to give Curtis and his team a call as soon as you can. As soon as you filled out the contracting paperwork for us, you're going to be able to. We're going to send you an immediate email out. It's going to welcome you to Baltimore Life. It's going to give you instructions on how to log into the Secure Agent website. On that Secure Agent website, there's going to be all kinds of information, the agent guides. It's going to be product information, consumer information, anything you're going to need from Baltimore Life is going to be available to you out there. So all this information you don't have to take down. It is going to be available in the agent guide once you're contracted and can access that agent guide. There's a number. The call center hours are from 10 a.m. to 9 p.m. Monday through Thursday, and then 9 a.m. to 6 p.m. Friday Eastern time. If for some reason your sales situation is outside of that, you can either do it, as I said, by DocuSign, or you can also do it. You can call in at a later time, as long as I think it's within 3 or 4 days of the application date. We support both English and Spanish. I would tell you that if we do Spanish, kind of give us a heads up, give us a call beforehand at that call center number, and let them know that you're going to be calling in at a certain time with a person that only speaks Spanish, and we can be set up with a Spanish-speaking call center rep at that time. The interview must be completed in order to process the application, and the interview must be completed within 5 days. So if for some reason you took the application, you weren't able to call into the call center or get their signature within those, immediately you got 5 days from the date of the application to do that. I always like to point out again, we've got better than a 90% point of sale decision rate on our underwriting, so keep that in mind. And then as we get towards the end of the presentation, I always like to point out, and we get these ideas from people like you, and you know, this is where, you know, how do you find these clients? If you're working with annuity clients with annuities, you're going to have great access to a lot of clients and have this type of conversation. And it's really asking pointed question and pertinent questions to these clients. You know, do you have annuities not needed for daily living? That's the main thing. That's what's going to drive the source of funds for both of these products. You know, I always like to ask the question, do you have leave behind money? Now, having sat through this presentation, you're knowing what I mean by leave behind money, but it's always a good thing to ask the client, do you have leave behind money? Because then they're probably going to say, well, what do you mean by leave behind money, Doug? And it's, well, you know, if you got money set aside, it's either one of two types. It's either live on money you expect to live on, or money that you want to leave behind, which I call leave behind money. You want to leave it behind to your heirs, your kids or your grandkids, you know, church or charity, that kind of thing. So it gives you a chance to elaborate on that. If they've got live on money, you've got annuities that you can sell them out there. If it's leave behind money, these two products are great to discuss with the client. 1035 exchanges of old paid up policies. You know, back before we developed these products, my grandfather, when he died, and I was young, relatively young in the insurance business, because all of his policies were in a shoebox, as you typically find with a lot of these senior people. And he had a number of them. I think he had close to 20 policies, and they were policies with small face amounts, $250 face amount, $500 face amount. When he got married, he bought a $1,500 face amount policy. But you go back into the 20s and 30s and 40s, and you're going to find a lot of these seniors had policies that were bought when they were relatively small face amounts when they were younger people. And they've got a bunch of these. They're all paid up, typically all paid up policies. A lot of these people bought paid up policies back then. So don't overlook those in the cash value in them. They were bought with much pretty outdated mortality tables. So look at the opportunity to utilize some of that cash to use paid up policy cash value to fund one single premium whole life paid up policy. A universal life rescue, that's a term I use. I started in the insurance business August 27th, 1984. So in about a month, I will have 4 years in the insurance industry. But back in the mid 80s, we were selling a ton of universal life, and we were selling at extremely high interest rates, 12, 13, 14% interest rates. In some cases with Kentucky Central, a company that's no longer in business probably because of this, was selling at a 15% interest rate. So they were buying it and putting money into it primarily because of the way the cash value could increase and not necessarily the death benefit. A lot of these seniors still have these policies. They may be paying a fairly significant amount of money as an annual premium, but they're still seeing, even though they're paying a fair amount of money in premium, they're still seeing their account value every year decrease down. And they know that because they're getting an annual statement every year that demonstrates very thoroughly what happens every month on premium going in, cost of insurance coming out, any interest that's credited, all the pluses and minuses that goes into that, and then what at the end of each month, how much is still left in it. Any company that issues a universal life policy is obligated to the client to give that information out to the client every single year. And if you go by and you're not familiar with universal life, or you've never sold one, or not familiar with those, ask to see their last annual statement, and you can see there whether or not that account value is going down or not, and how much it's going down. If it's going down fairly dramatically, you can look to see how long it is before that account value gets to zero or less, and that's about how much more time they've got before that life insurance policy goes away. And if you could take that and say, okay, still got $36,000 of cash value left in it, it's not going to buy the same death benefit, but you take that $36,000 and let's say it buys $70,000 of death benefit. They're never going to have to make another premium payment. They can put that into the single premium whole life. From year one, the cash value is going to continue to go up from there, and you've rescued that UL. But it's also critical that you freed up whatever amount of premium they're paying. So let's say they're paying $300 a month in premium on that. Not only did you save their cash value and give them a death benefit that they're never going to have to worry about going away, you saved the amount of money that they're paying out there. They can use that money to spend on whatever they want, or you can find a way to utilize that for additional insurance types of products. Burial account, even though this is not a final expense product, you'll find ways. And one of the first sales that was ever made, I put this on my parents. I found my parents had 2 CDs set aside. One CD on my mom for $10,000, so my brother and I wouldn't have to pay any final expenses on there for them when they died. And my dad had a $10,000 CD for the same purpose. I was able to take about $6,000 of my mom's CD and buy a $10,000 single premium whole life. I took about $7,000 of my dad's CD and bought a $10,000 single premium whole life. So now they've got $10,000 for my brother and I when they pass away, but I freed up about $7,000 in total for both of them to do that. So don't overlook the fact those clients may already have some money set aside for things that they think they've already got kind of pigeonholed or earmarked for, and show them ways that they can utilize that. Those are not big sales, but they do add up. And then some of the other ways that we don't see it a lot, but it's a way to reduce 1099 income and exposure to income tax on Social Security. And then in the business market, potentially reducing tax liabilities on corporate retained earnings, or to finance an employer's obligation under a non-qualified deferred comp plan, or maybe even a vehicle for after-tax employee contributions. We don't see much of that at all, but it is, if you work in that business market, it is a way out there of finding a way, especially the single premium whole life, to do that. I always like to say, you know, all our agents, and we've had a number of IAMS agents in the past that have qualified for our incentive trips. It's $95,000 of conference credit. It's conference credit because it's 10-to-1 ratio. So if you wrote $100,000, if you wrote $100,000 of premium, it's going to be $10,000 of conference credit. So $950,000 of combined credit between a premium between the single premium whole life and the generation legacy qualifies you and an adult guest to join us at the Secrets Resort in Papagoya, which is just off the Pacific coast of Costa Rica next May. We have a qualification period between January 1st of this year, so we're a little over halfway through, all the way through the end of December. But if you do that, it's all-inclusive resort. We pay all the accommodations. We pay the airfares for you and an adult guest. It's really a great trip. We take every agent and qualifier and guest that qualifies. So there's no limit on it. There's no maximum on it. And we love to host these things. We conduct no business. There's no business meetings or anything like that. So you're not stuck in a business meeting with me while your guest is out by the pool or out by the beach or doing something fun. So if you want to talk business, I'd be glad to talk business with you, but it's really a fun trip to go on. So keep that in mind. And then I told you earlier on that I was going to pass on the agent services call center. This number is available out there in just about every agent piece that you have on the Secure Agent website. But any question that you've got, you know, I always say that your client is your client. My client is you. I'm never going to get to that end user for a Baltimore Life product if you don't see how we can help you grow your business. With that said, we have a client service center. If that client wants to change beneficiaries, they want to change something, they want to do something, if they can't reach you, they can always call our client service center and get through to them, and our client service center can help them with that. You're my client. We have an agent services call center set up separately from the client service center that's designed to help you answer any question that you may have. There's a number, 877-533-2468. If they can't help you for some reason, they're set up to be able to facilitate you getting that answer as quickly and efficiently as possible. You know, I don't want you calling in and having to call to 2 or 3 different departments, getting to be put on hold, getting to be put on for long periods of time, or having to make different phone calls to different departments to find out different things. They can help you. This agent services call center can help you with anything from contracting issues to new business issues to pending cases. Just about any question that you got, you can't locate something on the website or how to find it. Or I mentioned earlier, if you've got an illustration that's above the requirements but still within our expanded net amount at risk requirements, you can call this number and they can run that illustration for you and get you out that software or get you out that illustration yourself. So with that, Curtis, that's the end of my presentation. So I can turn it back over to you. If you don't have any questions, anybody have any questions, I'll be glad to try to answer those now.
Yeah, thanks, Doug. So we had a couple of questions. Some of those I think you answered as you went on, but on the gen leg after the 10 years, the whole life or the annuity payout, they are just left with the life insurance policy at that point. Is that correct?
You're trying to liquidate that SPIA and do it tax efficiently. So you've liquidated it over a 10-year period, spread the tax liability out over that. At the end of that, that client's going to have a fully paid up 10-pay whole life product, or if they're an older age, it's going to be the 7-pay.
Okay. And then on that gen leg, they can use qualified or non-qualified money on that if they want to. Is that correct?
Yeah, absolutely. We use 401k money, IRA money.
You're cutting out a little bit, Doug.
Yeah, yes, they can use that. That's for qualified fund, any type of qualified funds. Okay.
All right. So I'm going to go ahead and I'll launch our final poll today, which is if you're not currently contracted with Baltimore Life and you'd like to get contracted with them and get access to that product suite, just check yes on the box there. Doug, I thought you did a great job. Baltimore Life has been a really good partner with us over the years, and I do think there's just, and I thought this was good at the end there where you were talking about sources of premium. There's just so much opportunity in the SPL space right now, and it's just going to continue to grow. And I think it can make a lot of sense when you think about that tax-free, efficient transfer of wealth, and then also, the clients are going to build some cash in there as well. And so if they get down the road and want to make some adjustments, they can. So I appreciate everybody taking the time to be on the call today, and then Doug, really appreciate you taking some time to go over this with us.